Good day, everyone, and welcome to another episode of For Our Financials Financial Forum. Today, we will just get started. It's America's anniversary birthday, so happy birthday. Hope everyone's ready for their 4th. Have a great 4th. Stay cool in this heat, but we will certainly get us started today. So let's get started with markets in motion. So last week, stocks finished the week kind of mixed. Falling oil prices lifted the Dow Industrial, with concerns around AI valuations weighed on the broader market quite a bit. The S&P 500 declined 1.95% for the week, and the NASDAQ Composite dropped a sharper 4.6%. Funny thing, in contrast, the Dow Jones Industrial Average actually gained 0.6%, and overseas market, though the developed market actually fell by 1.33%. So let's kind of take you through how that week played out. So the week began with a lot of pressure on tech as AI trade came under increased scrutiny. That weighed on both the S&P 500 and the NASDAQ, while again the Dow managed a modest gain. Rotation continues away from tech continued into Tuesday, with larger consumer stocks outperforming and helping support that Dow Jones Industrial. Even so, the S&P fell about 1.4% for that day, and the NASDAQ dropped more than 2% on Tuesday. Middle of the week, markets were mixed. We had strength in healthcare, financials, and industrials. Those helped push the Dow slightly higher on both Wednesday and Thursday. Meanwhile, the ongoing weakness in tech stocks kept the S&P and NASDAQ under a lot of pressure. And those declines were more moderate than earlier in the week. By the end of the week, the markets kind of leveled off. The Dow posted its third consecutive weekly gain, while the S&P 500 and NASDAQ remained under steady pressure. On the economic front, the Fed's preferred inflation gauge, the PCE index, came in as expected for May. The core measure, which excludes energy, rose, though, to its highest level since October 2023. But investors didn't see that as much as a surprise. Looking ahead this week, investors will be watching a full slate of economic reports. On Tuesday, that includes the S&P Home Price Index, consumer confidence, and job openings. Wednesday brings ADP employment report, key manufacturing data, and on Thursday, the markets will focus on the monthly employment report, weekly jobless claims, and factory orders. So that's your markets in motion. And now I will kick it over to Jeffrey for Finance in Focus this week.
All right. So in this week's Finance in Focus, investors are weighing growing concerns about stock market valuations alongside a notable shift toward bonds, too, interestingly enough. So veteran investor Jeremy Grantham is sounding the alarm, saying the U.S. stock market may be the most expensive in American history. He points to a key measure comparing total market value to GDP, and we often call that the Buffett indicator. And that now sits around 235%, well above levels seen during the dot-com bubble. According to Grantham, the surge in artificial intelligence investments has helped drive those elevated valuations. While he notes that timing of peak is pretty difficult, periods like this have historically been followed by significant declines, which the year 2000 kind of offering the closest comparison. So he also highlights signs of market enthusiasm, including massive valuations for companies like SpaceX, which he believes could represent the kind of access typically seen near market tops. And at the same time, another trend is emerging beneath the surface, a growing shift by investors into fixed income. And that's kind of back to the bonds I was mentioning at the beginning. According to BlackRock, flows in the bond ETFs are running around 60% higher than last year's record pace. And investors search for income stability in an increasingly uncertain environment. That move kind of reflects several factors, including stock market volatility, ongoing inflation concerns, as we've been talking about, and then a changing Federal Reserve backdrop, too. So investors are focusing more on real yield returns after inflation, which has become more attractive as interest rates remain elevated, of course. So there's also growing attention on policy uncertainty with new Fed chair and less forward guidance from policymakers. Markets may be pricing in additional volatility, particularly in fixed income. As mentioned earlier, inflation remains a key piece of the puzzle. So recent data shows core inflation at its highest level since 2023, reinforcing expectations that the Fed will maintain its inflation fighting stance. So the takeaway from all this, while growth things like AI continue to dominate the headlines, as we're all seeing, investor behavior suggests a more cautious tone balancing risk and equities with a renewed focus on income and diversification, which is something that we've always been preaching. So, and that's your finance and focus. And we'll move now into this week's Wealth Wisdom Workshop.
Passive portfolios are risky, kind of leading into this diversification piece that we're talking about. So today we're diving into something that most investors don't think about enough, but it can have a massive impact on your financial future. That is downside risk management, as I like to call it. So we're going to unpack why traditional passive portfolios may be riskier than they appear and how a better approach can help protect your wealth over time. And as you listen, I want you to reflect on your own situation because this isn't theoretical. This is personal. So, Jeffrey, why does downside risk matter at all?
So, of course, most investors are focused on average returns, as we see a lot. So, this your 7%, 8%, maybe 10% over time. But there's a problem with averages, and that problem is they don't tell the full story. So, what actually really matters is what happens when the markets go down and how much of that loss you actually experience. So, the downside risk that Marcus is talking about. Historically, a traditional 60-40 portfolio it saw drawdowns as large as 50% over long periods of time. And now let's pause and think about that for a second. If your portfolio dropped 30 to 50%, how would you react? Would you stay invested or feel the pressure to make a change? How would that impact your retirement timeline or income plans? So, for many investors, especially those nearing or in retirement, those losses aren't just numbers on the screen. They can permanently change what your portfolio is able to support, and that's why managing downside risk is so critical.
Yeah, let's bring this into a more recent example. So,
Mhm.
earlier this year, during the market volatility tied to the geopolitical tensions, even diversified portfolios declined. So, I'm going to say that again, even diversified portfolios declined. So, an 80-20 portfolio fell over 3% in just a short period, and more conservative mixes still lost money. So now here's the key idea. Most portfolios simply accept those losses, but they don't have to. So when markets get volatile, do you feel like you have control or are you just riding it out? Have you ever looked at your portfolio during a downturn and thought there has to be a better way? If you could cut your losses in half during tough markets, what would that mean for your confidence? So this is where active risk management and helping and hedging strategies start to make a real difference, not just in performance, but in financial behavior.
Mhm. So the real test of any investment strategy isn't really how it performs when everything is going up. It's what happens during times of stress. So during the COVID crash in 2020, markets dropped fast and traditional portfolios followed. But risk managed strategies saw smaller drawdown. Then in 2022, we saw something unusual. Stocks and bonds both declined at the same time. Traditional diversification didn't work. But again, risk managed approaches held up better. And over time, they've actually delivered about 2% higher average annual returns as well on top of that. So would you trade a little complexity for more consistency? Or what matters more to you, maximum growth or smoother or more predictable results? If your portfolio felt more stable, would you be less likely to make emotional decisions? 'Cause that's what we're really talking about here. Not just returns, but better investing and better behavior.
Yeah, so let's make this practical. So if you're in a traditional passive portfolio, here's what you're dealing with. Big drawdowns, sequence of returns risk, volatility that creates stress, and no built-in inflation protection. On the
Mhm.
flip side, a risk management approach aims to reduce those losses, keep you invested, deliver more consistent outcomes, and support reliable income. So, does your current portfolio have a plan for when markets drop? Are you confident in how your investments will behave in the next crisis? Or are you hoping diversification alone will be enough? These are the types of questions most investors don't ask until it's too late.
So to wrap up here, here's a big idea. Passive investing passive investing, isn't wrong, but it's incomplete. In today's world, where markets shift quickly, inflation changes direction, and global events drive volatility, risk management matters more than ever. The goal isn't to avoid risk altogether, it's to manage it in a way that allows you to stay invested, protect your capital, and continue growing over time.
If nothing changed in your strategy, how would your portfolio handle the next major downturn?
Mhm.
What would need to be different for you to feel truly confident in your plan? And what's the cost of not addressing that risk today? Thanks for listening to the Wealth Wisdom Podcast. If this episode got you thinking about your own portfolio and whether it's built to handle real world risk, that's exactly the point. We'll see you
Mhm.
next time. Everyone have a great fourth.